Hi there. This is the story about RobinHood. RobinHood Markets. Ticker symbol HOOD. Right now, if you look at the market cap, is about 88 billion and the stock price about $100 per share. It went from $10 to 100. Almost 10x. The most important question is whether RobinHood Markets is a great buy at the current price. And the answer, you'll find it in this box. During this video, I'll open the box and you'll find the answer. And to understand the answer from this box, you have to look at the business and how they make money. Here is the trick, because if you don't understand how they make money, you'll be lost. Because in 2024, they reported their earnings about 1.4 billion and revenue close to 3 billion, 2.95 billion. So net margins were about 47%, quite high. If you look at the past, pay close attention to this. Revenue, yes, has increased a little from 1.3 billion to 1.8 and 2.9 billion. But their earnings for 2022 was minus 1 billion, 2023 minus 540 billion. Here's the thing. If you look at their cash flow from operations for 2024 was about minus 157 million. And they report the revenue 1.4 billion. So you see that there is a big difference between their free cash flow and earnings. 2023, another big difference, 1.1 billion cash flow from operations and net earnings minus 500 million. 2022, 1 billion minus a loss of 1 billion, cash flow minus 800 million. Here it was much closer. Now, if you look at the composition of the revenue, you will see that they make money from transaction assets, 55%, and net interest. Transaction, how do they make money? Do they charge a fee? No. They make money when you buy and sell options, crypto, or equity. They make money from the price difference. When you press the buy button, they offer you a higher price. When you press the sell button, they offer you a lower price. Be very careful here if you think that RobinHood offers free trading. Be very careful. Compare RobinHood with other brokers. Check their prices in real time and you'll see big difference. So in this way they make money through those margins, 55% of their revenue. And net interest comes from the money they lend to traders, margin accounts, and other services. Now, here is the thing. This difference in their cash flow from operations occurred when the revenue from net interest has increased to 47%. Because if you look at the past, this interest percentage was much lower. Now, if you look at their cash flow, you will see some important items. Securities borrowed and loaned, and payables to users and receivables from users. Well, those two items move the cash flow from operations a lot. And that's why you see this big difference. And then you have to wonder, to think whether their earnings are sustainable. Because if you can't rely on their earnings and they report what they really make, that will be a big problem for investors, for the market cap, which is quite high at this level. Anyway, let's say they make 1.4 billion in earnings. Even if they make 1.4 billion, the current market cap is too high. At this level, it's way overvalued. You can see from this level a drop of 50%. Be aware of this. Be aware of this. You can see a drop of 50%. Now, there are also other important indicators. Yes, they have some cash, about 8.8 billion. Half of it is required for regulations because they are forced to hold some cash. But still, their earnings, revenue, don't justify this high market cap. And when you see those net margins about 47% for a broker, this is way, way too high. It's not sustainable. So their earnings, I think they aren't reliable in my view. They will go down. 47% net margins, this is way, way too high. And when you look at the cash flow from operations, see with minus, a loss of over 157 million, a big question mark. Should you trust their accounting, their earnings? In my view, not. And if those earnings aren't reliable, are much lower than what they report, then for sure you'll have a drop in the stock price more than 50%. And of course, if you look at the stock price over the years, you see that it went from $10 to $100. So be prepared. Now, you also have to understand the other indicators. Yes, maybe the market doesn't care about those earnings, this free cash flow, this loss. They think that the revenue will grow more in the future. And they have chances. Because if you look at the total platform assets, they're about 221 billion. And from this, 18 billion deposits. It's like they charge a fee about 1.5% on those total assets. And the revenue, 2.95 billion. Okay. Now, if they double their total assets from 221 billion to, let's say, 500 billion, and this is possible because the total assets invested in the stock market, especially in equities, is a lot of trillions. So it's possible to see the total assets to increase from 221 billion to 500 billion to have a double. Revenue can double from this level to have a 2x. And then even more from this level to go to 1 trillion. This is possible. Now, if this happens, they continue to grow, even if their earnings aren't reliable, but they continue to grow and make a nice profit, yes, the market cap may be justified. But still, till then, till they reach 500 billion in total assets, total platform assets, or 1 trillion, there is a lot of time. I don't think that they'll grow overnight. So you have to be aware of their growth rate and the current market cap of $88 billion. For the moment, they have 25 million funded customers, of which 3.19 million are gold subscribers. As they make money from this revenue, stream of revenue, but it's not that much compared to transaction and net interest. And because of those securities borrowed and loaned and payable to users and receivable from users, their earnings are distorted. Look at the cash flow from operations. Of course, they announced other services. They want to become more like a bank, digital bank, with this lending. But you have to be very, very careful. Yes, they'll continue to grow. There is no doubt for that. They'll continue. There is a lot of place. There is a lot of room to grow from 221 billion. And if they can maintain this fee about 1.5%, now in my view is unlikely. The fee will get lower and lower because of competition. But let's say even if 1% of 1 trillion, that's quite a lot in their revenue. So it's up to you. Just look at the revenue. Let's say 3 billion, right? 3 billion in revenue. Price to sales, 10. Let's say price to sales, about 10. That means 40 billion. Now, as they are expected to grow a lot, as they increase their revenue earnings, more recently they reported a double in their net income, this price to sales might be 20, right? Higher, 60 billion. The valuation, if they continue to grow. But still, compare 60 billion here with 88 billion market cap, current market cap, is way, way overvalued. And if you buy it right now, you have the risk of a decline of about, close to 50%. Of course, if you wait, if you believe in the future of this company, RobinHood, that they will grow over the next 5 to 10 years, yes, you buy now, the price will go down after a while, and then it will rebound, go up again. But if you want great returns, be careful of the price you pay. And to open the box and tell you whether this is a great investment or not, the answer, you can see it here. No, it's not a great investment because the price is too expensive. Now, if you want great companies that continue to grow more in the future and the price is cheap, you have a margin of safety, then you can simply go to my profile and press join. And there you have access to my portfolio and see every transaction I do. So if you want great returns, go to my profile and press join. And if you have other questions about RobinHood, who steals from the rich and give it to, in this case, management, please let me know in the comments.